Nearly every day, most people around the world touch a piece of plastic or a phone with a small logo on it, tap it against a machine, and watch a purchase go through in under 2 seconds. Most of those people assume, without ever really thinking about it, that the company behind that logo is a bank, that it issued the card, that it's lending them money, that it decides their interest rate, maybe even that it's holding their money somewhere. Almost none of that is true. The company is Visa, and one of the most consequential facts about how the modern economy actually works is that Visa isn't a bank at all. It doesn't issue cards to consumers, it doesn't extend credit, and it doesn't hold anyone's money. What it built instead is something stranger, and in some ways more powerful than being a bank, a network that sits between almost every other participant in a payment, without ever becoming the lender, the merchant, or the account holder itself. To understand why that distinction matters, you have to understand what actually happens and who's actually involved in the 2 seconds between a card tapping a terminal and a purchase being approved, because that brief moment hides an entire hidden cast of characters most shoppers never think about. Start with the card itself. It wasn't issued by Visa, it was issued by a bank. Call it the issuing bank, which is the institution that actually opened the account, ran the credit check, decided the credit limit or verified the checking account balance, and takes on the risk if the cardholder doesn't pay. That bank could be a large national institution or a small regional one. There are thousands of them around the world, each issuing cards under license, each carrying the Visa logo, each making their own independent decisions about who qualifies for a card and on what terms. On the other side of the transaction sits the merchant, and the merchant doesn't deal directly with the issuing bank either. It works with its own bank, known as the acquiring bank, or simply the acquirer, the institution that set up the merchant's ability to accept card payments in the first place, that receives the funds on the merchant's behalf once a transaction clears, and that takes on a different set of risks and responsibilities than the issuing bank does. So already, before Visa enters the picture at all, you have 2 separate banks, one representing the buyer, one representing the seller, that have never done business with each other directly, have no existing relationship, and have no built-in way to trust or communicate with one another. This is the actual problem Visa exists to solve, and it's worth being precise about the shape of that problem. Because it's not fundamentally a technology problem, it's a coordination problem, at a scale that's genuinely difficult to picture. Imagine trying to build a payment system from scratch in a world with thousands of banks. If every issuing bank had to negotiate a direct relationship with every acquiring bank it might ever need to work with in order to let their respective customers transact with each other, you'd need an almost incomprehensible number of individual bilateral agreements. Every bank connected to every other bank, each pair working out its own technical standards, its own security protocols, its own rules for who bears what risk when something goes wrong. That system would be so complex, so slow to build, and so fragile that it essentially couldn't scale past a small handful of institutions. What Visa built instead was a shared common layer sitting above all of these individual banks, so that any issuing bank and any acquiring bank anywhere in the network could transact with each other without ever needing a direct relationship, because both of them already have a relationship with Visa, and Visa has already solved the technical and trust problem once, for everyone rather than each bank solving it separately, over and over, for every other bank it might ever need to deal with. This is the core of what a payment network actually is, and it's fundamentally different from what a bank does. A bank's core business is holding deposits and extending credit, taking on financial risk directly, and profiting from the spread between what it pays depositors and what it charges borrowers. Visa's core business is moving information and coordinating trust between institutions that hold deposits and extend credit. It doesn't lend the cardholder money, the issuing bank does that. It doesn't hold the merchant's funds, the acquiring bank handles that. What Visa moves in the critical seconds during a transaction isn't primarily money at all, it's a message. Walk through an actual purchase, step by step, and this distinction becomes concrete rather than abstract. A shopper taps their card at a terminal. That terminal, working through the merchant's payment processor and acquiring bank, sends a message requesting authorization, essentially asking, can this specific card cover this specific amount? Right now, that message travels through Visa's network to the issuing bank that actually holds the cardholder's account. The issuing bank checks the account. Is there enough available credit or balance? Does the transaction look legitimate? Does anything about it trigger a fraud flag? And sends a response back the same way it came. Through Visa's network, back to the acquirer, back to the merchant's terminal, arriving as a simple approval or decline. This entire round trip, spanning potentially two different banks on opposite sides of the world, typically happens in around a second or two, a speed that's only possible because Visa isn't relaying this message through some improvised ad hoc channel, but through a purpose-built global infrastructure designed specifically to move exactly this kind of message reliably at enormous volume, with strict security and fraud detection layered throughout. It's worth pausing on that word, authorization, because the moment a purchase is approved isn't actually the moment money moves. The approval simply confirms that the issuing bank has agreed in principle to pay for this transaction. The actual movement of funds between banks, a process called clearing and settlement, typically happens afterward, often bundled together with many other transactions and settled in batches, rather than transaction by transaction in real time. This is part of why a pending charge can show up on a statement before the merchant has actually received the money. And it's another example of how much of what Visa does is fundamentally about coordinating information and obligations between parties, with the actual transfer of funds happening as a separate, somewhat delayed process handled through the banking system itself, not by Visa directly moving money out of one account and into another. Understanding this structure also clarifies where Visa's revenue actually comes from, and why it's easy and inaccurate to lump all the fees involved in a card transaction together, as if they all belong to Visa itself. When a merchant accepts a card payment, several different fees get deducted before the merchant sees the rest of the money, and these fees flow to different participants for different reasons. A significant piece of that cost is called an interchange fee, and this money doesn't go to Visa, it goes to the issuing bank, as compensation for the risk it took on by extending credit or guaranteeing the payment, and for the cost of running the infrastructure and fraud protection tied to actually managing that customer's account. A separate, generally much smaller fee is the network fee, and this is the piece that actually goes to Visa itself in exchange for building, running, securing, and continuously upgrading the shared network that made the whole transaction possible in the first place. Conflating these fees, treating interchange as if it's Visa's own profit, is one of the most common misunderstandings about how the company actually makes money. And it matters, because it changes who's actually setting the price a merchant pays and why. This structure also explains something that often confuses people about how card networks actually make decisions. Visa doesn't set a cardholder's interest rate, and it doesn't decide whether someone qualifies for a card or how large their credit limit is. Those decisions belong entirely to the issuing bank, because the issuing bank is the one carrying the lending risk. Visa's role is closer to that of a standards body and a shared utility. It sets the technical rules everyone in the network has to follow. It operates the infrastructure that carries transaction messages around the world, and it enforces security and fraud standards across the entire system. But it deliberately stays out of the actual lending relationship between a bank and its cardholder, because entering that relationship directly would mean taking on exactly the kind of credit risk the network model was built to avoid. Now, understanding what Visa does still leaves an important question, only partly answered. Why did this particular structure end up dominating global payments rather than some other arrangement? The answer sits in a specific and genuinely difficult kind of business problem, one that shows up whenever you're trying to build something economists call a multi-sided network, a system where the value for any one participant depends heavily on how many other, different kinds of participants are already using it. Think about what it would take to launch a payment network from absolute zero. You need banks willing to issue cards under your brand, but no bank wants to issue a card that customers can't actually use anywhere. because a card nobody can spend is worthless to both the bank and the cardholder. You need merchants willing to accept the card, but no merchant wants to install new equipment and pay fees to accept a card that almost none of their customers are carrying. Because a payment method with a tiny user base isn't worth the hassle. You need consumers willing to carry and use the card, but no consumer wants to carry a card that barely any stores accept, because an unusable card provides no value at all. Each side of this system is waiting on the other sides before it's willing to commit, which creates a genuine chicken and egg deadlock that has killed plenty of would-be payment networks before they ever reached meaningful scale. Visa's actual history, expanding gradually from a fairly narrow base, building relationships bank by bank, market by market, and steadily proving out reliability and fraud protection along the way, reflects just how difficult and slow it is to break that deadlock. There was no instant network effect. It had to be built deliberately, side by side, convincing banks to issue the cards while simultaneously convincing merchants to accept them in a mutually reinforcing process that took years to gain real momentum. But once that momentum did build, the same dynamic that made launching so hard became the network's greatest long-term advantage, because multi-sided networks tend to compound in value once they cross a certain threshold of adoption. Every additional bank that joined and issued cards made the network marginally more attractive to merchants because it represented more potential customers who could now pay with a card. Every additional merchant that started accepting the card made it marginally more attractive to banks and cardholders because it meant the card was useful in more places. Every additional cardholder made the entire system marginally more valuable to merchants who hadn't yet signed up because it represented a larger pool of potential customers they were missing out on by not accepting cards at all. This is the fundamental logic behind why payment networks, once they achieve real scale, become extraordinarily difficult for a new competitor to challenge head-on. A brand new network doesn't just need better technology or lower fees. It needs to somehow convince a critical mass of banks, merchants, and consumers to all move simultaneously, away from a network that already works well for all of them, toward one that, by definition, starts with none of the accumulated trust or acceptance the incumbent already has. This same scale, though, comes with real friction that's worth acknowledging honestly rather than treating the network model as a flawless system. The fees embedded in every card transaction, interchange fees paid to issuing banks, network fees paid to Visa, and additional processing fees paid to the merchant's acquirer or payment processor add up to a real cost that merchants ultimately bear, one that gets factored in one way or another into the prices charged to every customer, including the ones who pay in cash and never benefit from the card network at all. This has made interchange and network fees a persistent subject of regulatory scrutiny and legal dispute in multiple countries, with merchants and regulators periodically pushing back on fee structures they consider excessive, particularly in markets where a small number of major networks handle the overwhelming majority of card transactions and merchants have limited practical alternatives if they want to accept cards at all. The scale of the network also creates a different kind of structural dependency, one that goes beyond simple pricing disputes. As card payments have become the default way a huge share of commerce happens in many parts of the world, merchants, banks, and even entire national economies have become deeply reliant on the continued reliable functioning of networks like Visa's. Reliant in a way that gives enormous, largely invisible importance to a piece of infrastructure most people never think about until occasionally it fails. And the resulting outage makes clear just how much everyday commerce now runs through a small number of shared private networks rather than through any single bank or government system. It's also worth addressing directly a question that comes up naturally once you understand this system. Do newer digital payment methods, mobile wallets, tap-to-pay apps, buy now, pay later services, and the various fintech alternatives that have emerged in recent years actually threaten to bypass this network entirely? In most cases, and this often surprises people, the honest answer is that they don't replace the underlying network so much as sit on top of it. A digital wallet on a phone frequently still has a Visa or equivalent card linked behind the scenes, meaning the same authorization, interchange, and network fee structure is still operating underneath a more modern-looking interface. The wallet has changed how the customer initiates the transaction, but it hasn't necessarily changed who's actually coordinating trust between the issuing and acquiring banks behind it. There are genuine exceptions, certain account-to-account transfer systems, and some government-backed national payment schemes in specific countries do route around traditional card networks entirely. But for the enormous majority of digital and card-linked payment innovation built over the past decade, the underlying rails are more often than not the very same network infrastructure this story has been describing all along, simply wrapped in a newer, more convenient front end. Pull all of this together, and the actual shape of Visa's business becomes clearer than the version most people carry around in their heads. It isn't a bank pretending to be something else, and it isn't simply a brand stamped onto a piece of plastic. It's a coordination layer, a shared set of technical standards, fraud protections, and message routing infrastructure, sitting deliberately between thousands of banks and millions of merchants who would otherwise have almost no efficient way to trust or transact with each other directly. Visa doesn't lend money, doesn't hold deposits, and doesn't decide who deserves credit. What it built and defended over decades is something less visible, but in some ways harder to replace: the connective tissue of an entire global payment system, valuable specifically because so many different, competing institutions on every side of it have already agreed to build on top of the exact same shared network, rather than each trying to build their own.